key things that have really disrupted the endowment model. So number one, there's been a flood of capital into alternatives. So we like to say alternatives have just become mainstream because it's not sort of really alternative anymore. So private equity, private debt, hedge funds, you add all of the alternatives together, I think it's more than $20 trillion, I think, in alternatives. And it's about 10, 15% of the global capital base. So now it used to be a real niche asset class where it was quite uncorrelated. You could actually sort of fish for outperformance. There was inefficiency. And it's actually become quite a big asset class. So question is, where do you go if you've got so much choice? And how do you know you're going to pick the ones that actually can deliver on outperformance? And on that theme, the other thing that's happened is, of course, the rise of passive investing. And so you've got passives that have really become a huge industry. And, 20 years ago, it was a niche industry and you could buy maybe the S&P 500 ETF, but you couldn't do much more. And therefore, when you sort of put those trends together, you're sort of saying, where do I go for outperformance? And by the way, why do I bother paying all these fees? Because maybe I can harness a lot of the diversification, a lot of what we're talking about through just a set of low cost, ETFs, right? In effect, I can get the beta and maybe there isn't much alpha available. Those are the challenges to the model. So how do you respond to those challenges? We have adapted the model quite significantly, and we've talked about the advanced endowment approach, but maybe I'll sort of start with, at the highest level, what we did after the global financial crisis about 10 years ago was to sort of change the asset allocation mindset to one where we started thinking about the world of investing as sort of having two separate engines. And so we sort of said, we came up with this concept of a twin engine plane, where you're sort of saying that the first engine is the beta engine. So what is the beta engine? It's the engine where I talked about risk premia. You can do it through low cost instruments. So go make sure your portfolio's got different types of risk premia. You have credit in it, you have different asset classes. You could do that in a low cost way, just pulling it all together. That could be just fine. So if you're a small investor, you're sort of saying, look, let me just get that right.
Yeah.
That's fine.
If you're small, you can fly on one engine.
You can fly on one engine and, it's fine.
Yeah.
You don't pay too much. It's not very expensive to construct that engine. And so that engine works. But if you aspire for more, you could create a second engine, which I call sort of the turbocharge engine, which is the alpha engine. You can separate those two decisions to some extent, right? So you can sort of say, look, here's the beta engine, the alpha engine. And why do you do the alpha engine? It's not just for outperformance. Yes, you want to outperform over the long run, but the alpha engine gives you two things. One, it gives you potential better returns, right? So outperformance, but it also gives you more resilience, because a lot of what you can do with the beta engine, you don't get that extra resilience unless you go for the alpha engine. By definition, a lot of the illiquids, you can't buy an ETF for the illiquids. And so for illiquids, you have to go to the alpha engine.
You're increasing the diversification.
You're increasing exactly. You're increasing diversification. As part of doing that, you're harnessing potentially higher returns, and certain opportunities cannot be accessed through the beta engine, right? You can't buy an ETF, right? So if you're really sort of saying, how do I go for more resilience and potentially higher returns? You have to look to the alpha engine. The endowment model then is all about get the beta engine right, and you got to get the alpha engine right. And the advances we've made are all around how do you get this alpha engine right? Because here's an area where there's tons of capital that's gone into it. Where do you look for it? Because the danger with the alpha engine is, of course, it's expensive. And so if you're not careful, you'll end up, your return on investment from the alpha engine is going to be negative because you've had it all eaten up by fees. And so that's the danger of the alpha engine.
Do you manage both engines?
We manage both engines, right? So our model is to put everything together and work out how do you harness engine number one most cost effectively and in a way that's very, efficient, lean. And how do we put all of the resources behind optimizing that alpha engine that we can bring to clients?
Are there any rules of thumb or trends that you've noticed with regards to the balance between the two engines, depending on the type of investor?
Yeah, I think with scale, the moment you're beyond a particular size, I don't know of any investors who don't try and get engine number two working for them.
But are we talking 90-10 or 50-50?
Yeah. So the way I think about it is because capital is actually not a constraint in it. So what constrains you on the alpha engine, right? So if you look at the alpha engine, let's talk about it, because there's two aspects of the alpha engine I talked about. One of them is how do you boost your returns and how do you boost your resilience? So let's just talk about both aspects. So you talk about how do you boost your returns. There's an overarching construct, but I'd break it down into three subparts. So part number one is you have to embrace illiquidity, because the best way to get outperformance is embracing illiquidity. Number two, you have to try and move early into opportunities rather than being late to opportunities, because there's a supply demand imbalance where there's capital,
Mm,
there's less capital available than the opportunity is. And
mm,
so the earlier you can move into certain types of opportunities, for example, specialist lending. We went into private debt about 13 years ago before it became a formal asset class. So if you can move in earlier into certain types of opportunities, you have the ability to capture excess returns, right? So it's sort of illiquidity, move early. And then the last thing, which I think is increasingly important, is the partnership structures are critically important. So for us, given our scale, we're able to structure partnerships with our asset managers, which are not high fee partnerships necessarily. So you can structure them as separately managed accounts, and co-investments become a
ah,
really
mm.
important part of structuring those relationships effectively.